Canada's finance department just took out a $30 billion loan, going into massive debt to essentially try their hand as a hedge fund. I'm talking about their plan to spend the borrowed $30 billion on a special money-making strategy that, at least they believe, will help them support their new and expensive plans. But the problem? Well, it's that this plan includes buying billions of dollars worth of mortgages from Canada's big banks, wrapped up into a special mortgage-backed security, so that the government can get paid a large portion of the interest that millions of everyday Canadians pay on their mortgages every month. This further complicates an already heavily intertwined relationship between the incentives of the Canadian government and the Canadian real estate market. And, well, to make matters even more questionable, if these mortgages were to ever default, well, the government of Canada would be on the hook to bail them out. So, in a roundabout way, Canada is facilitating the creation of new mortgage-backed securities while also now becoming the primary buyer of them. And I have a lot to say about this financial funny business because it makes me wonder why everyday citizens are being so heavily targeted with taxes when the government seems to think it can act like a hedge fund to generate funding for their spending instead. So let's take a closer look because I really think this is going to blow your mind and it's not something that many people are talking about. But first you need to understand what Canada mortgage bonds are and how investors profit off of the mortgages of average Canadians. And then once you understand that, everything else is going to make a lot more sense. You might already know that when Canadians want to buy a home but don't have enough for the full 20% down payment, they're often offered the option of putting down a smaller down payment, but sometimes even as low as 5%. But because this increases the perceived risk of their mortgage, since they're borrowing more relative to what they're putting down, they're also forced to buy mortgage insurance. That's what we see here, mortgage loan insurance, for thousands and thousands of extra dollars, which is all paid up front. Now, despite what many people believe, this mortgage insurance doesn't protect the homeowner in any way, even though they're the ones that pay for it. It actually protects the banks that gave the homeowner the mortgage. If the homeowner ever defaults on their loan and stops paying their mortgage payments, any losses to the bank are covered by this mortgage insurance that the homeowner paid for when they first got the loan. The majority of this mortgage insurance is purchased from CMHC, that's the Canadian Mortgage and Housing Corporation. There are some other people who will give mortgage insurance, but this is the primary provider. Now, the CMHC is what's called a crown corporation, meaning that they're a company that's fully owned by the government, but technically they operate independently from the government, but you can think of that what you will. So these banks that the Canadians are getting their loans from often don't actually have the money on hand to loan to the home buyers. They don't have the cash on hand. But instead, they raise this money, and they do so by bundling tons and tons of these insured mortgages together and create something called a mortgage-backed security, or an MBS. Now, this mortgage-backed security idea might be familiar to you if you've ever studied or seen movies about the great financial crisis in the States. Now, these mortgage-backed securities are actually a lot more simple than you might think. You see, these banks will give out tons of different loans to a bunch of different people, and they're probably all at different interest rates. Somebody might be paying 4%, 5%, 3.5%, and so on and so forth. Now, they'll put all of these mortgages into sort of a big pool for which there is an average mortgage rate. Let's just say that across all these different mortgages, some lower, some higher, they wound up at an average of 4%. So they know on average for this group of mortgages that they're going to get paid 4% interest over the course of a calendar year from all of these people that are paying their mortgages. That's both the principal and the interest on those mortgages. They then wrap all of these individual mortgages in this pool into a bunch of different little tiny pieces of paper, we can think of it as. Each of these pieces of paper representing a portion of this pool of mortgages, which they then sell to investors, selling off all these little pieces of paper to investors. By buying these papers, well, investors will receive a yearly return of whatever the rate is, and will also receive all of the money that they've initially spent back at the end of this. Oftentimes, there's a little bit of a spread between what they charge on the average mortgage for the pool and what they offer to investors, and the banks get to keep that small difference. And by selling these pieces of paper, these mortgage-backed securities, well, then the banks can quickly raise money to actually have the cash on hand to give to the homeowners that need those funds in order to close on the property they're receiving a mortgage on. This is a pretty good deal for both the banks and for the investors because they know that as long as the homeowners keep paying their mortgages, they're going to be able to pay the investors this interest rate. And even if the homeowners ever stopped paying and default on their loans, well, these mortgages are still all insured by the CMHC, so the banks aren't going to lose money, and nor too are the investors going to be able to lose money because even in a worst case scenario, these mortgages are all insured. However, the process of actually buying these mortgage-backed securities or these pieces of paper we've been talking about, that process was pretty complex. The payment schedule and the type was not really traditional, and it essentially took a lot of paperwork to actually make people want to purchase these mortgage-backed securities. It wasn't a great deal for them, and people weren't buying these MBSs, these mortgage-backed securities. So in the year 2001, the CMHC, remember this is a corporation owned by the government, decided to make it easier for banks and mortgage creators, mortgage originators, to sell these mortgage-backed securities. They're going to make it a lot easier to get these off of your books, sell them to other people. Here's how. So the CMHC, this crown corporation, created the Canada Housing Trust, a sort of intermediary organization with one goal and one function, and that is to buy a whole bunch of mortgage-backed securities from Canada's big banks. You see, not enough people were buying these mortgage-backed securities, so the Canada Housing Trust said, hey, I'll actually be the one to buy them from you, commercial big banks. The Canada Housing Trust then, again, repackaged these mortgage-backed securities into a package that was a lot more attractive to investors. It acted a lot more like a bond that commercial investors would be familiar with owning. They wrapped these mortgage-backed securities into something new, something called a Canadian mortgage bond, something that was really easy for investors to then buy. So instead of these investors buying mortgage-backed securities directly from individual banks, instead they just went to the Canada Housing Trust now and bought Canada mortgage bonds instead, a far more simple product and a far more liquid product for these investors, meaning they can buy, sell, and trade them more easily. And very quickly, this became the most popular way for banks to offload these mortgage-backed securities. This pie here represents the entirety of the mortgage-backed securities that were created in Canada, and over half, this 213 as of 2015, was bought by the Canada Housing Trust and used in the Canada Mortgage Bond Program. This red segment is actually mortgage-backed securities that weren't even ever sold. They're just on the balance sheets of these banks. They continue to hold them. And then this sliver here went to other investors. But the point here is that the Canada Housing Trust, well, quickly dominated the market for mortgage-backed securities. Way easier to just buy from the Canada Mortgage Bond than to buy these individual mortgage-backed securities. Jesus. You might already be thinking that it's a little bit fishy that the CMHC insures these mortgages, then buys the mortgages back from the banks as mortgage-backed securities, repackages them as Canada mortgage bonds, and sells them to investors. The rationale, though, is that this helps banks and financial institutions to offer more loans to more Canadians because they can now generate additional funds by selling these mortgage-backed securities, these packaged pools of Canadian mortgages. But things get even crazier because just recently we found out that the government of Canada now wants to become the largest investor in Canada mortgage bonds, these packaged and repackaged mortgages from the big banks. And they want to go into massive debt in order to be the largest investor in Canada mortgage bonds. Now, this is absolutely wild, and it makes the whole thing just feel incredibly incestuous. But before we get into that, I want to take a second to thank the sponsor of today's video, and that's Crypto.com. I want to start off by saying crypto can definitely be risky. It's not for everyone, and you can definitely lose what you put in. But more and more Canadians are including crypto as a small portion of their investment portfolio, and that's myself included. I first started getting interested in crypto for reasons that are really related to a lot of the stuff we're talking about here today. It just doesn't feel right that such a small group of people have so much centralized control over our entire financial system. And I'm personally interested in a future where crypto could be part of the solution to this problem. So if you're looking to buy crypto, well then Crypto.com is a solid place to do so. You can fund your account and choose from a selection of over 250 different cryptocurrencies, all with Canadian dollars. But personally, and obviously this isn't tailored financial advice for you, I tend to stick to the more tried and true Bitcoin and Ethereum. Additionally, if you choose to keep your crypto on the Crypto.com platform, you can earn some interest via their Earn product. And over the long term, though, I think that it's beneficial to learn about self-custody and to transfer your crypto to a cold storage wallet that's secured by a hardware wallet that you personally control. I recommend looking into that. So if you're looking to buy some crypto, then make sure to check out Crypto.com and use the referral code RUSS, that's RUSS, or you can just click the link in the description of this video. And once again, thank you to Crypto.com for making videos like these possible. So just over the past 8 months, we've found out that the government of Canada wants to become the largest buyer of Canadian mortgage bonds, which, as a reminder, are bonds that are packaged mortgage-backed securities packaged by the Canadian Housing Trust, which is a subsidiary of the Canadian Mortgage and Housing Corporation. These mortgage-backed securities, again, are sort of pieces of paper representing parts of a pool of mortgages all paying a certain interest rate. Take a look at this. Let me zoom in so you can see it a little bit more clearly. Look at what they say here. The government will begin purchasing up to an annual maximum of $30 billion of Canada mortgage bonds starting as early as February 2024. And they give 2 reasons for why they want to do this. They say that they want to reflect the objective of supporting stable, cost-effective funding for mortgage lenders. And the second reason, they want to generate revenues for initiatives such as affordable housing. What they're saying here is essentially 2 things. Number 1, we want to make sure that these banks can offload their mortgage-backed securities very easily. We want to give them accessible funding to provide highly leveraged prospective homeowners with these mortgages. And we want to buy a bunch of mortgage bonds to make sure that they can do that. And second, they say, we want to try to make a bunch of money by buying these bonds. But you might be asking, well, Russell, where does this $30 billion that they want to use to buy these mortgages, where does that come from? Doesn't the government's money come from the taxes that you and I pay? Well, to that I'd say yes and no. You see, the tax money that's collected by the federal government that all of us pay, well, that total amount of money doesn't cover the entirety of the spending that the government does to support all of these different social programs that many people have come to rely on. In reality, the vast majority of the funds that are used by the government to actually make these programs happen, well, it's all borrowed money. And in fact, about a quarter of all of the taxes that we pay actually just goes towards paying the interest on the loans that the government takes out in order to operate. We've talked about it on the channel before, so I'm not going to go too into depth about it, but the government borrows this money by selling IOUs to investors in the form of Government of Canada bonds, where the government pays all of the money back that you loan them, as well as a little bit of interest on top when the bond ends or when it matures. Of course, the government never actually ends up having the cash to pay back the bonds or to pay back their loans when their loans are due and the bonds reach maturity. So instead, to solve this problem, they just issue more bonds to refinance the debt to pay off the first loan, going into debt to pay off the original loan, and that cycle continues over and over again, so on and so forth. And that is exactly where the government of Canada is starting to act more like a hedge fund than they are a government. Take a look at this. This is from the 2024 budget that was just released about a month ago. This is the section of the budget where they say how much they're going to need to borrow just this year, which totals at $500 billion that the government's needing to borrow this year, of which $414 billion is refinancing previous existing debt that's coming due. Now, this $414 billion is only a portion of the $1.35 trillion of debt that the Canadian government holds, but this is just the amount that is coming due this year, for which they need to borrow more money to pay off. On top of this $414 billion of refinancing that they're doing, they're also taking out about $86 billion to fund all of the new spending this year, a third of which will be the $30 billion of Canadian mortgages that they want to buy in the form of Canada mortgage bonds. They're taking out $30 billion of debt to buy Canada mortgage bonds with that money. So the government is essentially borrowing 150% of the amount it already would be borrowing in order to allow them to buy Canadian mortgage bonds. And remember, they're doing this because they think it will be a money-making endeavor for them. It says right here they have a desire to generate net revenues for initiatives such as affordable housing. Essentially, they want to borrow money to make money. And here is how they plan on actually making this money. And it kind of feels like a hedge fund strategy. They're doing something called an interest rate arbitrage. It's actually super simple. Essentially, the government of Canada can borrow money at one interest rate, and they can buy Canadian mortgage bonds, which pay a different, higher interest rate. So what they're saying here is we can borrow at a lower rate to purchase something that's going to pay us a higher rate than the rate we're borrowing at, and we can pocket the difference between the revenue that's generated on these Canadian mortgage bonds and the cost of servicing the debt that we need to take out in order to buy the mortgage bonds. And up until just this year, all of this was just a plan. But already in the past 4 months, the government of Canada has spent around $11 billion on this scheme. Take a look at this. This is from the Bank of Canada's website, from a page called Canada's Mortgage Bonds, Government Purchases and Holdings. It essentially tracks when the government of Canada has been buying these bonds, how much they've been buying, as well as the difference between their cost of borrowing to the return on the bonds that they'll be getting. Here's a record of the big 3 purchases that they've made so far. The first one being on February 14th for $3.5 billion. On 2024, March 13th, that was $4 billion. And on May 16th, just really recently, they purchased an additional $3.5 billion. They have a section of the chart here that shows the interest rate that these bonds that the government is buying yields, or the interest rate that it pays out. And then they also have a column here called the initial spread, which I believe is showing the difference between the government of Canada's cost of borrowing through issuance of government of Canada bonds and the amount that they're earning through this yield. So you can see here, this is 0.41% of a spread between the cost of borrowing and the return they're getting, a 0.24% and a 0.39% spread between, again, the cost of borrowing, the money that they need in order to spend all this money on the mortgage bonds. So this whole thing kind of complicates the chart that we've been building, this big web that you can see here. The government of Canada essentially is guaranteeing the debt that they hold, these bonds that they hold. It feels so insular, like it's all just a bunch of the same people doing handshakes behind each other's back, trading the sort of same things over and over again. Instead of these mortgage bonds just going to investors now, well, over 50% of these bonds are now going right back to the government of Canada. The government of Canada, of course, owns the CMHC, who insures all of these mortgages and essentially insures the debt that now the government of Canada is holding. If a large portion of these insured mortgage holders stopped paying their loans, well then the CMHC, which remember is essentially just the government of Canada, would be on the hook to pay the big banks and to make these banks whole so that they don't default on the mortgage-backed securities that they themselves sold to the Canada Housing Trust, which is a subsidiary of the CMHC itself. And this also makes sure that the Canada Housing Trust's mortgage bonds that they've created, those also won't default because the CMHC will bail out everyone along the chain. So the government of Canada is guaranteeing that they're going to get a yield on the debt that they hold, which is kind of their own debt in a way, because they're on the hook to bail it out if a worst case scenario happens. And if that worst case scenario did actually happen and this whole spiral of debt, borrowing and lending were to start unraveling, well, it would likely be the Bank of Canada, Canada's central bank, bailing the whole system out, probably by printing hundreds of billions of dollars, much like they provided a bailout for the economy at the beginning of the pandemic when they started their quantitative easing program, printing hundreds of billions of dollars each week and adding that to the economy. And this is what really pisses me off, because at the end of the day, when there are these massive bailouts made possible by the creation of new money, well, it's actually the average Canadians who are hurt. They're the ones on the hook because they see inflation going up, making the dollars that they save less valuable, while all the assets that maybe they want to own one day but are currently owned by the wealthy, real estate, stocks, all kinds of different assets, well, those types of assets tend to go up in value in dollar terms when more money is added to the system. Assets go up in value when there are more dollars to purchase those assets, right? So all the elite who have regulated and who have created this system over the long run, ultimately they'd be fine in a worst case scenario because they're holding these assets, while average Canadians just trying to get by, they're the ones paying the true cost. And to me, the whole system just seems like it's set up so that the elite can take financial risk and reap the rewards privately, just themselves, while the losses, if things were to blow up, would definitely be socialized, even if it's a sort of covert socialization of these losses across a population that doesn't even realize it's happening, because everyday Canadians, most people, unless you're watching this video, aren't paying attention to the intricacies of the financial system and probably wouldn't be able to clock that this was even going on if it did. But even if a worst case scenario doesn't happen and the government actually does make money here by borrowing money to buy mortgage debt that they themselves essentially guarantee, well, there are still some problems with the government moving in this direction. This is a great article by Nicholas Neary on the Hub, pointing out some of the issues with this strategy and some of the sort of behind-the-scenes way that this could actually make things worse for the government of Canada. He says that it's impossible to predict whether these Canada mortgage bond purchase strategies will make or lose the government money over time. They say the government will earn on the spread between the mortgage bonds and the sort of borrowing that they do through their bonds, and that these earnings may or may not be exceeded by increased issuance cost due to the growth in federal borrowing. What he's saying here is that issuing more bonds to take on more debt as the government of Canada means that there's going to be a higher supply of bonds, more bonds in the market with the exact same amount of demand. Now, this means that the rate the government of Canada has to pay on its debt could go up as bond prices fall due to the increased supply of bonds. Now, if this happens, it's possible that this increased cost as a result of the government taking on more debt to buy Canada mortgage bonds, well, that increased cost of their debt now could negate any potential financial gains that the government could make by executing this interest rate arbitrage strategy where they're just banking on pocketing the spread. And here's another more broad, more societal negative, and maybe this is just how I'm feeling, but increasingly playing with these obscure financial tools and strategies, along with the Bank of Canada's quantitative easing and money printing experiments since 2020, well, it all just kind of makes me feel like, for governments, money is just this abstract, made-up pixie dust sort of thing. Well, we don't have enough tax revenue to finance programs? Well, okay, well then we'll just take out more and more debt, and we know we're never going to pay it off, but we'll just refinance it until the end of time, kicking the can down the road. It's not really real if you don't look behind the curtain. And as a working Canadian, it makes me feel so disenfranchised with Canada's tax policy that weighs heavy on average Canadians who are trying to make a living, from the lower to the upper middle class alike. Now, when for a government, budgets don't matter and taking on debt has no consequences, then why are we taxed so heavily? We already know that the taxes the government takes from us don't even come close to paying for all the social programs we rely on. So why not reduce the tax that working Canadians pay and borrow more if this borrowing seemingly has no consequences for you? It makes me feel like all these new tax ideas, how we can sort of generate more revenue for the government, it seems to me like it's all just political virtue signaling, not actually a legitimate way to try to raise money and reduce our deficits. Look at this whole debacle going on right now with the increased capital gains tax and the debate surrounding that. Are you telling me that the hundreds of millions of dollars that they'll extract from citizens through this new tax is actually meaningful to the government, while at the same time they're borrowing $100 billion, $100 billion new dollars every year, and needing to take out $400 billion to refinance their existing debt? Like, it doesn't seem to me that these marginal tax changes are actually making any kind of difference in Canada's financial picture. So why are they burdening actual Canadian citizens? It's like these new policies are just put together by thinking, well, what narrative can we sell to Canadians today? How can we make them mad at somebody that they shouldn't be mad about? And how can we force our political opponents to look bad or try to have to dodge questions so that we can stay in power? It seems like that's more the direction of politicians thinking than actually trying to solve any actual problem. Maybe I'm just starting to get too cynical here, guys, from making all these videos. Maybe you can steer me straight here. I found this stuff interesting. I didn't know it before, so I thought I'd bring it to you. Let me know what you think about this. What do you think about this Canada mortgage bond buying program that the government of Canada is bringing in? How do you think this impacts the banks versus average Canadians, mortgage holders versus renters? What have I gotten right here? What have I gotten wrong? Let me know. I'm just like anyone else trying to figure this stuff out as I go along. I'm just sharing it with you as I try to do so. Let me know down in the comments. Subscribe to the channel if you haven't already done so. And you can get all the sources for these videos by joining the mailing list just underneath this video. I send them out after every single video. But with all that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.